Well, you could almost hear that sigh of relief from a mile away here in the city. So, yes, the fear was that inflation would miss to the upside. It's missed to the downside. So you're seeing yields a little bit lower this morning. Yes, sterling a bit weaker, but largely this was the data print that people hoped for, not least to the Treasury, as it takes some of the near-term pressure off the cost of government borrowing.
Now, inflation is still a little above the 2% target, but it's no higher than the Bank of England had been expecting a few months ago. And with the economy sluggish, I think this should leave them on track to cut interest rates gradually further in coming months. But I think what we'll see during the course of this year is services inflation and core inflation slowing further, and the Bank of England gradually able to ease from a restrictive policy stance, which is where they are now, to something more like a neutral stance where they are no longer dragging on the economy so much. The big swings in financial markets in the last few weeks and months haven't really been a UK-centered issue. It's been led by the US economy. The US economy has been stronger than people had expected, and there are worries that the policies of the incoming Trump administration will add to inflation and add to government borrowing in the US. And that's caused markets to revise their expectations, the outlook for US interest rates, a shift to higher for longer, leading to higher bond yields in the US, a strong dollar against everything. And the UK is really being caught in the slipstream of that. The adjustment to a higher real interest rate world, the US sort of sets the weather for financial markets as a whole, means that other currencies are weakening against the US dollar, and the UK has been a part of that, but it hasn't been a unique part of it.